You have built significant equity in your Greenwich home. Maybe 500,000, maybe 800,000, maybe more. But when it comes time to buy your next house, you hit the same wall every move-up buyer hits. You cannot buy until you sell, and you do not want to sell until you have somewhere to go. It feels like a deadlock. But there is a short-term financing strategy that is letting Greenwich homeowners break that cycle, make clean, competitive offers, and move on their own timeline. Today, I am walking you through exactly how bridge loans work in Greenwich, Connecticut, the real costs, the real risks, and how to decide if this is the right move for your situation. I am Charles Nedder, a realtor here in Greenwich, Connecticut, and I work with move-up buyers navigating this exact decision regularly. By the end of this video, you will understand how a bridge loan is structured, what it actually costs, and the alternatives you should consider before committing to one. So what is a bridge loan? It is a short-term loan, typically 6 to 12 months, that lets you tap the equity in your current home to fund the purchase of your next one. You are essentially borrowing against your existing property so you can buy before you sell. Once your current home sells, you pay off the bridge loan with the proceeds. The key benefit is straightforward. It lets you make a strong offer on your next home. In Greenwich, that matters. Sellers in this market want clean offers. They do not want to wait for your house to sell before their deal can close. A bridge loan removes that contingency entirely. You show up as a buyer who can close on the seller's timeline with no strings attached. In a competitive situation, that is a significant advantage. Now let us talk about what this actually costs. Bridge loans carry higher interest rates than a traditional mortgage, typically in the range of 8 to 12% APR. That sounds high, and it is, but here is how the math works in practice. Say you borrow $200,000 as a bridge at 10% APR for 6 months. Your total interest cost is roughly $10,000. There are also origination fees, which typically run 1 to 2% of the loan amount. So your all-in cost on that $200,000 bridge might be $12,000 to $14,000. That is real money. But compare it to the alternative, losing the home you want because your offer was contingent, or rushing to sell your current home at a discount because you are under pressure to close. When you frame it that way, $12,000 to secure your next home on your terms starts to look different. Quick question for you, what is the risk? The biggest risk with a bridge loan is simple. Your current home has to sell. If it does not sell within the bridge loan term, 6 months, 12 months, whatever you have negotiated, you are carrying 2 mortgages plus the bridge loan payment. That is an expensive position to be in. This is why the strength of your current home's market position matters before you take out a bridge loan. If your home is in a high-demand neighborhood, priced correctly, and likely to sell within a few months, the bridge loan risk is manageable. If your home has been sitting or is in a slower segment of the market, that risk increases significantly. Your agent and your lender should both be honest with you about that before you commit. And here is where it gets practical for Greenwich specifically. Your attorney is coordinating the closing timeline on both transactions, the purchase of your new home and the sale of your current one. The bridge loan adds a third layer of coordination. Your lender, your attorney, and your agent all need to be aligned on timing. This is not a situation where you want to figure it out as you go. The timeline has to be mapped out before you make your offer. One more thing, a bridge loan is not your only option. There are alternatives worth exploring. A home equity line of credit, a HELOC, can serve a similar purpose if you already have one in place or can get one approved quickly. The rates are typically lower than a bridge loan, though the approval process may take longer. Some brokerages offer their own buy-before-you-sell programs that function like a bridge, but with different terms and structures. And in some cases, you can negotiate a delayed closing on your purchase, giving yourself time to sell your current home before you have to close on the new one. That does not work in every situation, but when it does, it eliminates the need for bridge financing entirely. So to bring it all together, a bridge loan lets you buy before you sell by borrowing against your existing equity. It removes the sale contingency from your offer, which makes you a stronger buyer in Greenwich. The cost is real, higher interest rates and origination fees, but the math often works when compared to the cost of losing the home you want. The risk is carrying 2 properties if your current home does not sell on time. And the decision should involve your agent, your lender, and your attorney, because in Connecticut, all three need to be coordinated for this to work. If you are sitting on equity and feeling stuck, give me a call at 203-524-4303. Let us map out your options and figure out the right path forward. I am Charles Nedder from Greenwich, Connecticut. I will see you in the next one.